Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Jeff Levine, Professor of Practice and Tax Planning at the American College of Financial Services, Sophia Duffy, Associate Professor of Business Planning and Program Director at the American College of Financial Services, and we have Michael Finke. He is the Professor of Wealth Management at the same institution, and we're here to discuss potential tax legislation in 2025 and 26 and what investors and financial advisors should be considering. It is great to have all of you with us. Welcome to Trade Talks. And Jeff, I'd like to kick this off with you,
Sure.
discussing tax legislation, why it's more likely to get through. What is unique about tax policy, and what do you think we'll see in 2025 and 2026, and what should investors anticipate as these changes come through?
Yeah, it's a great question. I think the biggest thing, Jill, that distinguishes tax policy from a lot of other big topics that our government can tackle is that tax policy can move through the Senate with a simple majority vote. As we all know at this point, Republicans have control over the White House, control over the House of Representatives, and control over the Senate. So they have the ability to pass legislation, but normally in order to be able to get to a vote in the Senate, you need 60 votes to pass or to avoid a filibuster, right? We always hear about the filibuster, and that gives the party that may have the minority interest at least some power. However, when it comes to fiscal policy like taxation, you can pass a bill based on reconciliation, which requires only a simple majority vote in the Senate. And indeed, that's how we've seen a lot of major pieces of tax legislation pass in recent history. If we go back to 2010, when the so-called Obamacare laws were passed, right? The Affordable Care Act, that was done by reconciliation. In 2017, when Republicans passed the Tax Cut and Jobs Act, that was done by reconciliation. So there's a pattern over the years of when big tax policy is done, it's often done when one party has control. They don't need 60 votes in the Senate, which Republicans don't have, but they don't need it for tax policy while they need it for most other things. Now, with that, what should we expect? Well, we should expect tax policy to happen relatively soon next year. This is sort of a layup, if you will, because most of it is already built in. In large part, we should expect to see an extension of the existing tax policies because they were put in place by Republicans when they controlled the House, the Senate, and the presidency back in 2017. Will there be some changes? Almost definitely, but they're likely to be more on the margins, whereas core tax policy is likely to remain relatively stable now beyond the end of next year when it was otherwise set to go back to the old rules that we had in 2017 and prior years.
Right. So that removes some of the uncertainty and some of the unknowns. But Sophia,
Yep.
are there any significant tax planning considerations for individuals and financial advisors given the potential for tax policy changes under the Trump administration?
Sure. Yeah, as Jeff mentioned, we can likely expect extensions of the provisions under the Tax Cuts and Jobs Act. So, as far as planning for most individuals, it may really just be status quo, right, as we've been doing since those provisions were enacted. But some of the new ideas that have been proposed could actually create some significant tax impact. It's too early to put any actual planning in place, but we could prepare for things such as we've heard the corporate tax rate might be further reduced down to 15%. We've also heard a discussion on elimination or reduction of income taxes on tips over time. And it would be interesting to see if that changes the way that some wages are actually structured or how employee benefits are offered in certain industries. And then there's also the discussion of reduction of income tax on Social Security. So all of those, again, it's too early to really put anything in place until we see what's going to come in down the line. But for example, for a business owner, it might be a good idea to start looking into what it might take to convert to a corporation. Does that make sense for my entity? And really see if that can be put in place if the time if it does actually happen.
Right. And Michael, it's no secret that the U.S. tax scheme is quite complex. What are some of the typical mistakes that people make when thinking about taxes?
Well, first of all, is to focus too much on the short term and not enough on the long term. I think what we know right now is that I agree completely with Jeff that tax rates in 2025 are probably going to look a lot like they are in 2024. There are some things that people can do in 2025 to take advantage of some of those lower rates that if you compare it to where they were before the TCJA, I think it's pretty it's a pretty safe bet that tax rates are going to go up in the more distant future. So what are some changes that you can do right now? Well, you can start pulling money out of your traditional qualified assets in 2025. There's a very broad 24% tax bracket, and you can perhaps do a Roth conversion of traditional qualified assets if you think the tax rates are going to go up in the future. There's also a relatively low capital gains rate, and there are a lot of investors right now who have a lot of appreciated assets. So they might think of ways to take some of those capital gains in 2025 if they have taxable accounts. And then, the Roth conversion strategy, as I mentioned before, is particularly appealing given the fact that if we do extend the TCJA, essentially that simply kicks the tax can down the road. We're going to have to see increased taxes at some point in the future to address the cost of interest on the federal debt. So I think the best strategy for investors right now in the short run is not necessarily to assume that those lower tax rates are going to last forever and start filling up some of those tax brackets with your traditional qualified money in order to do Roth conversions to protect you against tax increases in the future.
Right.
Yeah, Jill,
So
I think Michael
sorry,
hit
go ahead.
on a really important point there, and Sophia also amplified it as well, which is, people tend to look at their tax bills very myopically. Like, what am I paying this year? Did I get my tax bill as low as possible? Am I paying as little as I could have this year? That is not a good way to do tax planning. It's too short-sighted. Instead of focusing on what does your tax bill look like this year, individuals should be focusing on creating the lowest lifetime cumulative tax bills. And while we're often taught to push off tax for as long as possible, sometimes that ends up backfiring because we push it off so long that we end up with much larger tax bills down the road. Whereas if we bring some income today forward to 2024 or 2025 in current years, we can pay income today, but at a much lower rate. So the simple thought here is when we're thinking about what should we do, stop focusing on your return, what it's going to look like this year, and start thinking about adding up all those amounts that you're going to pay over the course of your lifetime. And in some cases, if you're going to be lucky enough to leave a legacy to your heirs, what they might pay if they inherit some of your assets like retirement accounts as well.
Right. And Jeff, let's stay on that theme for a moment. And Michael, if you could follow up on this as well. I think part of it is the hype that's associated when it comes to tax time. I mean, you see it in the media, you see it in commercials, there's a sense of freaking out, or what am I going to get on my return, or how much I'm going to owe. So it's not being approached practically, right? So what role does tax planning in holistic financial planning? And more importantly, Jeff, why is it critical for advisors to be well versed in this area?
Yeah, well, I think the biggest thing comes down, you just mentioned tax time. And we think about tax time as, around January, February, March, and April, but that's tax prep time. And I think it's really important to highlight that tax planning and tax preparation are two very different things, right? Tax preparation is glorified history, right? It's reporting properly what already occurred. We're not really changing anything. We're mostly just telling IRS and Uncle Sam, here's what happened over the last year. Here's what I did. Here's what I was supposed to pay. Here's what I actually paid. And now either I'm going to pay you or you're going to give me back the difference. That's tax prep and what we call quote unquote tax season. But for financial advisors and for tax planners, which financial advisors should be, in my opinion, tax season actually extends, right? Tax season for a lot of advisors is like right now. They're busy going through and figuring out with clients, should we be adding more income? Should we be looking at making charitable contributions before year end? Are there things that need to happen today, again, that help to create that lowest lifetime tax bill? And while early in the year is a great time to review the prior year's return, now is actually a great time to do tax planning for a lot of people because we know a lot more. For a lot of people, whether they're business owners or they work on variable income, we don't know what their income is going to look like in January, February, or March. It takes until November or December to have a much clearer picture of what that might be. And so now is when your tax planners are actually going through a lot of their work and figuring what needs to happen before year end to keep that tax bill for a lifetime as low as possible. And advisors are great folks to do that sort of work because they're engaged with their clients on a regular basis. A lot of Americans, if they get their taxes prepared professionally, they see their CPA or tax preparer once, maybe twice in the year, right? They go, they bring their papers, they say, how is everything? How are your kids? Great, I'll see you in 2 weeks when I give you your tax return. But financial advisors are in their clients' lives all the times. They know if there's been a change of employment during the year and new opportunities or challenges have arisen. They know when there's a birth, a death, a marriage, divorce, a life event that can impact tax planning. So the advisors often have the best viewpoint into tax planning, which compared to tax prep, which is historical, tax planning is about looking forward and figuring out how to make that future lifetime tax liability as small as possible.
Right. And Michael, your thoughts around this?
You know, Jill, I'm a wealth manager, so I study investments. And when it comes to investments, what matters is the amount of earnings that you get to keep after taxes. So, I mean, people are getting 5% on their CDs right now. They're very excited about that fact. But the reality is that if you earn a 35% combined federal and state marginal income tax rate, you only get to keep 3.5%. And then the question becomes, what are ways to actually earn a higher after-tax return from your investment strategies? And to me, that's where an advisor, by having this type of knowledge, can really add consistent value. I mean, we know from the research that you can't really add value by picking individual stocks or picking even individual mutual funds. You can create a portfolio strategy, you can do asset allocation, but really when it comes to adding true value, asset location is where it's at. In other words, locating assets in the accounts, paying attention to the holding period of those investments, understanding what those tax rules are to allow you to generate a little bit of extra after-tax return. That is repeatable, that is consistent, but that requires a significant amount of knowledge about how to do it appropriately in order to generate those consistent extra after-tax returns.
And so, Sarah, let's talk about the nuances here. Isn't this the realm of a CPA or an accounting professional? Because we hear on commercials that talk about investments, make sure that you discuss this with your tax consultant and so forth. Or is it that distinction that Jeff had made between prep and, actual execution of doing your taxes? Is that where the difference is?
Yes, absolutely. I think Jeff really described it very perfectly when you look at the backwards facing versus a forwards facing approach. And while a CPA can look in the past and say, how do we report this correctly? Really, their responsibility is to make sure that it's compliant, right? It's reported accurately. And some savvy CPAs may be giving financial advice, right? How to take advantage of things in the future as well. But that's really not their focus. Whereas a planner is looking at a client in all stages of life, pre-retirement, what's the best amount to contribute? How is this going to impact us down the line? In retirement, how to minimize unexpected or unnecessary taxes, and then eventually transferring that to our heirs in the most tax efficient way possible. And in order to do that, they really do need to be looking across that long-term horizon. And that's a very different approach and different focus than a CPA who may be more transaction-based.
Right. And Jeff, that's a big responsibility, though. So tell me more about the recently launched tax planning certification program. How does this program equip financial advisors with the tools and knowledge necessary that they're able to navigate these complex tax issues?
Yeah, it's really been a privilege and an honor to bring this program to light along with others like Michael and Sophia to really make sure that advisors have access to this sort of knowledge for their clients. So when we look at advisor programs in general, right, some of the more advanced designations out there, your CFP, your CHFC, they cover a broad area of topics, right? They're covering things like taxation, they're covering things like investments, they're covering things like estate planning, regulation. There's a lot rolled up into one thing. And this designation is really meant to focus again on the forward-looking planning that we can do to minimize. So we're not talking about like, hey, when a client has this, you got to fill out this form. That's not what we're trying to do. It's not really where the advisors can add value. It's more like when these situations occur, when you see this fact pattern, here's a strategy that you can look to, or here's a Rolodex of potential solutions to talk about with your client so that you can figure out which one of these is going to both accomplish their goals in general, like getting money to the right people or saving for a particular event, but also do so in the most efficient way. And, advisors have clients with all sorts of goals and all sorts of objectives and in all different phases of life and all different ages. But in my experience, the one thing, and truly the only thing, that every single client shares in common is they'd like to pay as little in tax as possible. It's one core theme that runs across everybody, not in an illegal way, not trying to evade taxes, but legally, what can I do? What is within the realm of the law for me to take action today and in the future so that I can pay as little as tax as possible? And that is what this program is designed to help advisors do for their clients.
Michael, how is this differentiated from a CFP? It sounds as if the role of the advisor is really expanding.
Well, I think of the CFP or other types of fundamental designations, education programs, as giving you a base of knowledge. And just like any profession, for example, the medical profession, people specialize. And there are these areas of advanced knowledge. And I think tax planning is one of those areas where clients really have to rely on the advisor to recognize opportunities to be able to give them better outcomes. And I think the best way to think of an advisor is they're like a quarterback. You go to see your quarterback, and the quarterback has some, they hear about a specific situation and they think to themselves, this is an opportunity where I can take advantage of the tax knowledge that I know. I can bring in a professional at that point to help my client out and provide then a significant source of value. I think a lot of advisors may be insecure about the amount of tax knowledge that they have. This is an opportunity to really gain significant expertise to provide that added value.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.